Hello and welcome to you all for joining. Welcome to the Scope Ratings webinar on the 2021 Banking Outlook, which we've entitled First Real-Life Stress Test Since a Global Financial Crisis. My name is Keith Mullin and it's my pleasure to be hosting this session. I'm delighted to be joined today by Dirk Brandenburg, who is head of Scope's Financial Institutions Ratings team, and Marco Troiano, who's deputy head. And the way we're going to do this, rather than a presentation per se, I thought it would be perhaps more natural for me perhaps to pose to Marco and Dirk a few questions. And as we go along, please do feel free to type questions into the question panel. And then, depending on the question, we'll keep monitoring the question panel. We'll answer the question at the time that it's posed, or more likely, we'll wait till the end of the session and take them at that point. The Outlook itself was published actually last week, so you may have seen that. There's quite a few themes and thematics that have evolved over the course of 2020, and a lot of uncertainty potentially going into 2021. Without further ado, we should kick off. And I wanted to go to you first, Marco, if I could. Could you just kick us off with some thoughts about 2020 and how the year's been relative to your expectations? How have actually banks fared over the course of this year?
Yeah, good afternoon, everyone, and thank you, Keith. Well, obviously, it's been a year that I guess no one could have expected. We actually, at this time last year, we had published an outlook in which we pretty much called the top in bank financials in terms of the positive trends that we have seen over the past decade. But obviously, we were not expecting a recession of the magnitude of what we are seeing at the moment. COVID-19 took everyone by surprise, including the banking sector, including supervisors, of course, is the typical instance of external shock. So during the year, we have been quite negative. We've had rating actions skewed to the downside for our coverage. We've stayed away from sector downgrades or massive bunch downgrades of banks, but we've had a number of changes to the outlooks on the banks we cover. And actually, I think in the slide deck, we have a slide, slide 16, where we actually show the distribution of our outlooks at the end of last year and at the end of this year. So what has happened throughout the year. So if you go to slide 16, yeah. You can see the inner circle was our positioning basically January 1st. We had 8% of our ratings on positive outlook. This has gone down to 2%, and we have only 5% on negative outlooks, and this has gone up to 16%. Obviously, the driver is the deterioration in the operating environments, and we expect this actually to be reflected in worsening of bank financials. Not only for 2020, but also extending into the near future, so 2021, possibly 2022. Now, I want to point out that there hasn't been really a disaster. If you were just watching market performance at the beginning of the pandemic in March, you would have expected a massive banking crisis. The reality is that after the initial sell-off, it became clear that the public sector was intervening quite heavily and offering support to the stranded populations. We've had a number of government programs in different countries, including furlough extensions, grants, support to the corporate sector, support to SMEs. So all sorts of economic measures to try and limit the impact on the solvency of economic agents, which in the end are the customers of the banking sector. We've also had a lot of monetary support throughout the year. The ECB has announced a number of programs, including increased rate of asset purchases, new funding for banks, including emergency funding. And finally, we've had a number of supervisory measures actually helping the banks to, in a way, freeze the situation, at least on their asset quality at the pre-pandemic situation. So from the asset quality side, it's actually quite stunning that in a year where GDP is expected to contract, I don't know, 8, 9, 10%. We'll see what the number is at the end. There hasn't really been, a massive increase in corporate insolvencies. And actually, there's a slide there on slide 9. You can there is a chart that I think is quite stunning. This is basically showing the decline in GDP and essentially the disconnect with the corporate insolvencies, which have gone down rather than up this year. Now, this of course is due to the fact that there has been all of this support, and it might be only a temporary thing. So I wouldn't, bank too much on this. Among the other elements, I would say we had called the top in profitability, and yes, we've seen a profitability lull, although for different reasons from what we were anticipating. We were expecting, some plateau in capital levels for the sector at the end of last year, and we've seen something very different this year. Actually, we've seen quite a massive build-up of capital buffers, partly due to a decline in risk-weighted assets, partly due to the fact that banks are forced not to distribute dividends, and so earnings retention has been a big driver of accumulation. So for 2020, I would say it's been a year of a great scare, but overall, the banks have shown quite a bit of resiliency, and the fact that they're actually, vital to the economy, and there is still a lot of appetite from public authorities to support them.
Yes, indeed. Thank you. You touched there, Marco, on asset quality, and I wanted to perhaps push you a little bit on that. You mentioned that these governments and central banks have been very accommodative, and you say in the outlook that fiscal management measures have helped offset credit funding and solvency risk. But we are at some point coming to the end of these measures. Do you expect to see a precipitation or acceleration of asset quality deterioration in parallel with the sort of the pullback of those support measures?
Yeah, that's actually a very good question. It's very clear that the reason customers haven't defaulted and asset quality hasn't deteriorated is that you had these all these support programs, and there is a lot of concern among investors, among regulators and supervisors that there is actually a mountain of NPLs coming. My view is that actually we won't see a cliff in asset quality. Our expectation is definitely for an asset quality deterioration in 2021. And actually, we must point out that banks have also already provisioned, at least partly, for a deterioration in asset quality. Under IFRS 9, you have to provision on unexpected losses early on. So they took some provisions for deterioration of the macro environment, essentially, for their performing loans. So some of that is anticipated. I don't think we're going to have a cliff. And the reason is that I think the authorities will remain very pragmatic. We've already seen that there have been extensions, for example, to the moratoria, to the exception on the NP classification for loans under moratoria. There have been extension to the terms of the moratoria well into 2021. There have been extension already to the initial programs put out by the ECB. We've seen last week, more asset purchases, more funding for the banks. So my impression is that the public support will be lifted very gradually, and that the overall framework will remain quite accommodative. So there will be deterioration, but that will probably be at a sort of controlled pace and not a cliff effect, as actually some people seem to anticipate.
Okay, yeah, thanks for that. Profitability, low profitability in Europe particularly is not necessarily a consequence of COVID-19. European bank returns have been, or profitability has been fairly muted for some time. And so I guess, the question is there a way out? What's the way out? And has COVID changed your views? And are we going to see a rebound in profitability from 2021 on?
Well, first of all, I would separate the cyclical short-term impacts from COVID from the structural challenges. So the short answer to your question is no, we will not see a rebound in profitability in 2021. I think it's highly unlikely that that this is a short-term thing. It's a credit cycle. It's a recession that we might see an economic rebound, but as I mentioned, there is some delayed effect on the asset quality and on the provisioning needs. So I actually expect bank profitability to continue to suffer from this cyclical impact, high cost of risk for 2021, possibly for 2022. So that this is a credit cycle. Now the question is, what happens? Forget about COVID. We come out to the other side. What will a bank income statement look like? And here I would say that there are these structural factors that have been in play for quite a few years, and if anything, COVID-19 is exacerbating the problem. So the first one is the interest rate environment. This zero interest rate or negative interest rate environment and the flat yield curve. This is really not conducive to bank profitability. I mean, if we think of banks at their core as maturity transformation machines, they take savings on short-term deposits typically, and they lend it out at longer maturities. So they sort of operate this maturity transformation, and typically they get paid for it so long as the yield curve is not flat. There is upward sloping even by a bit. And what we have had now for a few years is actually a flat yield curve, and the COVID-19, I'm afraid, sort of prolongs this situation because of the massive amounts of public debt that have been added to governments' balance sheets, and then therefore the need for monetary authorities to remain very active. So this sort of problem is exacerbated. The other big structural trend is post-Great Financial Crisis. We've had a massive re-regulation of the sector. We've had an increase in capital requirements, which essentially means a decrease in the available leverage that banks can use. And at the same time, what we have is a compression of the risk premia in the markets, which is also due to the interventionist stance by central banks. And risk transformation is another of the key functions of banks. So banks are supposed to take funds with zero risk deposits from savers who don't want to risk their money, and then lend it out with some degree of risk against which they have to hold capital. So what you have is that at the same time, the risk premia, the return available for this function has gone down, and the leverage available for making money has also gone down. So I think this is not really going to change anytime soon. And with these premises, it's very difficult to see. It's really difficult to see banks becoming more profitable structurally. So I do see them as a value-destroying sector in the medium term.
Yeah, that was one thing I wanted to pick up on. You do actually, the outlook does say that banking is and will remain a value-destroying business for equity investors. That's kind of pretty, I mean, it's a forthright statement, but it's also pretty depressing for equity investors. So perhaps taking perhaps a longer-term view. I mean, you mentioned already cost cutting. What can banks do to accelerate cost cutting? How can they actually change potentially even their business model to drive sustainable top-line growth? I mean, these are the big issues of our day that we're facing.
Yeah, this is the ongoing discussion. The traditional brick and mortar savings and loans banking model is probably not well placed anymore. So we're likely to see some structural shifts in business models, which, by the way, have already happened. This is something that started with the great re-regulation. We've seen business models which are quite successful when they are operating very efficiently with few branches, when they're able to cross-sell products, especially low capital consumption products such as asset management, and we might see more of that. We might see banks de-emphasizing their traditional banking business and actually focusing more and more on side products which consume less capital and which are not as affected by the shape of the yield curve. And the other element, the one that you were mentioning, is definitely cost cutting, and you have to operate best-in-class efficiency ratios if you want to stay competitive in this market. And And the other thing I would mention is, you need to innovate. It's quite clear that the market is open for shake up in competitive dynamics. The customers have been moving already for some years to digital channels. COVID-19 has been a great catalyst for acceleration of this trend. So if you're up there leading this innovation, you might actually gain scale and market share, which will allow greater efficiencies. If you're not there, you might end up losing customers and precipitating into a spiral where your top line can't keep up with your cost base, and then you're basically just running after your top line with the cost cuts. So from this perspective, I think size is an advantage in this environment, and yeah, from this perspective, we can also read what's been going on in some of the peripheral markets with quite high-profile M&A announcements in Italy and Spain, for example.
Okay, M&A, I guess it's been the big talking point in Europe this year, and in fact elsewhere as well. But Marco, is M&A the answer? Is this the kind of silver bullet that's going to basically transform banks going forward? I guess there's domestic and cross-border M&A. What's your perspective there?
Yeah, to be honest, I don't think there is a silver bullet. I think M&A is one of the answers or part of the answers. There is definitely, a lot of self-help possible. I mean, banks can actually go about cost cutting as standalone entities. But it's quite clear that for some banks, at least, and I'm thinking about the smaller ones, there is a size issue. It's very difficult seeing very small entities compete with giants of both European banking and non-European banking, as well as potentially on the horizon technology companies that might decide to basically take a hit at the revenue pool of banks in Europe. So in order to be effective in this environment, you need to invest quite a lot of money, and probably that's going to be one of the drivers for the consolidation. I would also add that there is a strong financial driver at the moment, which is related to the dividend ban. Banks have actually quite significant excess capital buffers. Now, part of that might be eroded next year and the year after by credit losses, at least for some institutions. But there is significant money, in excess of what is needed to finance organic risk-weighted asset growth in European banking. And this can be actually one of the motivations why some banks might decide to, instead of keeping cash on the balance sheet at 0 or negative rates with a cost of equity of whatever 7, 8, 9, 10%, you name it, decide to buy a competitor, buy the cash flows of the competitors and the synergies coming from a potential deal.
Yeah. Okay. There is a question that's come in, Marco, which I wanted to ask you if that was okay, because it mentions it's kind of M&A related, and it's kind of a question that harks back to the kind of pre-GFC era. And the question is this: following concerns around too big to fail, many banks have refocused on core markets rather than pursuing global expansion. Do you see in the future banks merely growing organically rather than through M&A? And is this a positive for, I guess, a racing outlook?
Well, I think growing organically in developed Europe is going to be very difficult. So this is going to be the exception rather than the rule. Europe is a mature, I would say, overbanked market, not even mature. So there is, too many banks, and the levels of debt in the economy, of credit in the economy, are very high. Not only public debt, as we all know, but also, private debt. Now, with Basel III and the new regulations, part of this debt is not even, economically viable from a bank perspective. So it's not profitable to actually be lending to some segments of the economy. And this is actually why we haven't seen a lot of lending growth in the recent decade. So you can grow organically at the expense of competitors. So we might see organic growth for banks which are particularly good at, for example, developing an effective digital offer and stealing customers from their competitors. But as a whole, I don't think that is a possibility. So I see the sector actually shrinking rather than growing, as a whole. And in this environment, M&A is probably the most effective choice, because it allows you to accelerate on the cutting down of branches, personnel, and and still maintain the investment budget for what is needed.
Okay, thanks for that. Dirk, you've been very patient in this. Let me actually, if I may, turn to you. Marco had mentioned in passing the restrictions on paying dividends and share buybacks, etc. We've seen some movement from the Bank of England and the European Central Bank on this as regards this year's earnings. What's your view on supervisory restrictions on capital return? On the basis, bearing in mind some people have actually questioned the legality of this, but that aside, what's your view? And what do you think? Can you sort of perhaps give a view on your reaction to the ECB, Bank of England easing?
Yeah, thank you, Keith. I think as a rating agency, we should be in favor of dividend bans. So I get that point. I think. Though in this case, in particular with sort of blanket dividend bans, regardless of the financial circumstances, we were not too pleased to see that. And we also came up quite early, actually, arguing that this may not be the best idea because it does artificially depress the share prices of some of the stronger banks relative to the weaker banks, which I think over time, if that were to persist, makes it actually harder to consolidate the sector because the weaker banks feel their prices are too low and the stronger banks can't really capitalize on their relative strength. So I think from that angle, a blanket ban was understandably in the sort of political financial risk situation we were faced with earlier in the year. But I think going forward, that is not a very helpful tool to use. Certainly not for equity investors, but also I think for credit investors, the amount of cash that is preserved relative to the risk we are running is relatively tiny, and it does distort, I would say, crucial sort of price finding mechanism here around sort of who are the potential winners and losers in this environment. So we were quite pleased to see that first the Fed, they never went down the route of dividend bans and tied it to profitability early on. Bank of England did the same thing just very recently. Also pointed out in their release that they regard the ability to return capital as sort of fundamental to the functioning of the financial system, which I would agree with. And we also see movements in Europe now. I mean, I think the key point here is that it is not blanket. The haggling about should it be 15, 25%, I'm happy to leave that to the management teams and equity investors and the regulators on the other side. But I think the important thing is here to have an efficient price discovery in equity markets around the prospects of banks. So I think allowing differentiation of capital returns is quite important for that.
Absolutely. Okay, thanks. Now, it's almost impossible these days to have a conversation about pretty much any subject without, with reason and pretty correctly, without bringing in ESG factors. Now, this, I guess, is a subject for a whole symposium on its own, but just in so bearing in mind that the banking team at Scope recently pushed ESG factors into the methodology, can you talk a little bit about how you see ESG being factored into the banking narrative in coming years? It's a sort of been a blue sky question, but what's your perspective on how these factors are going to be brought to bear by governments, by regulators in the way that banks function?
Well, I think, first of all, it does matter to investors. So that is important for banks because ultimately that affects liquidity in terms of maybe not necessarily the pricing, but the access to markets. I think that's important here. And the second point is it matters to policymakers, particularly climate change matters to policymakers in Europe at the moment. Again, that has an impact on how regulators and then by extension ourselves and investors will look at the capital base of banks. So from that perspective, it is something that needs to be elevated in bank analysis. So we had it actually in the methodology already for a while, but we never really made it explicit because very often we found that these considerations were important, but not sort of critical as rating factors. And what we're starting early next year is we're sort of elevating it to a sort of more critical rating factor. So I think that's that will differentiate banks, particularly around the question: A, what is the disclosure, and then B, what is actually the sort of the preparedness of management and risk management funds and generally sort of investments, loan portfolios of banks, going forward, essentially. The actual risk here in the end may not be that different from other asset quality cycles we've seen, or sort of liquidity constraints we've seen placed on banks. But I think the sort of concentration of these factors and the explicit recognition by the investor base, that makes a difference, including central banks at this stage, right? Because we have indications that even central banks may sort of regulate the access to funding on that basis. So that's why we have to take this into account. The other underlying risks is hard to assess at this point. So you could actually argue, Ahmed, the risk is probably more in the climate policies than the actual climate change, i.e. climate change being a sort of pretty slow-moving, at least for sort of governments and sort of companies, slow-moving. I know there's sort of people who think it's moving a bit faster, but it's a very sort of predictable thing to involve, where the risk lies really in the policy responses and sort of erratic changes in carbon taxes, other measures, which then leave the banks with very large stranded assets that then require extra provisioning and so forth. And that's why we think disclosure going forward is going to be key.
Absolutely. Doug, I did want to ask you about digitization, but there's a few questions coming in. So I'm just, if I may, just going to move back to some of the questions so we can actually get those answered, and then I can ask you about digitization and the impact there. So I hope that's okay. And these, I guess, questions to either perhaps Dirk or Marco can answer. But one of the questions which has come in, which is this. The ECB has decided not to increase the multiplier of the tiering system that could have effectively supported the banks. In your opinion, why? Marco, do you want to have a go at that?
Yeah, no, I think that's a good question. Basically, when this tiering system was introduced last year, it was quite clear that it was meant to be a quid pro quo sort of allowing banks to basically not lose money on some of their excess liquidity there. Now, I think the problem this year is that the TLTRO 3 terms are so favorable for banks that they already allow a bit of an arbitrage between the interest rate that these banks will pay on the TLTRO line and the rate that they will get by depositing back on the deposit facility. So there is an incentive there, just to take the money and lend. And I think one of the idea was probably not to give banks too much of a benefit for just essentially taking the money and parking it back with the central banks, which is happening to an extent anyway. So the idea there is that you really want these banks to take the money and lend it out to the real economy to avoid the credit crunch during the pandemic. At least that's my reading of what the rationale might be for not extending that program.
Okay, and then there's another question, which earlier this year, the ECB actually weighed in on this subject, and it's an M&A related question. And the question is this: how important do you think is the opportunity to use the badwill that results when a bank is bought below book value for the consolidation process?
Yeah, I mean, I think it's not that important. I mean, there is a lot of noise around badwill, but I mean, in reality, this can essentially be used to offset the restructuring cost, and it allows banks to show better P&L during the initial phases of the integration. I don't think it's been, a massive driver from a capital perspective. More important, actually, than these, I think, are the other two two interventions from the ECB on consolidation. One was the clarification that they're not they're actually supporting this trend, and that they will not essentially raise capital requirements for the combined entity a priori, but they will just, the starting point will essentially be the average of the two merging banks' capital requirement. And this is some deviation from what we at least had observed in the past. Every time that there were some merger talks, there was also an associated talk of an increase in the so-called systemic buffers. And the other one is some leeway around early adoption of internal models, which would result effectively in a lightening of the capital requirement if a strong bank which operates on efficient internal models buys out a bank which with a less sophisticated capital framework. So I think these two were probably, from a capital perspective, in my view, are more important than the Badwill one. You're on mute, Keith.
That's it, breaking my old rules. Thank you, Marco. Dirk, has a question about what's your view about UK banks, whatever the outcome of Brexit?
Our view on UK banks has always been to, by and large, ignore the ins and outs of the Brexit negotiations. So that is based on our assessment that UK banks are reasonably well capitalized in this environment, and they're also very well regulated and supervised. And so we didn't really see any need to sort of, on a wholesale nature, to sort of downgrade or watchlist any UK banks just because of Brexit going on. I mean, we have adjusted our sovereign rating on the UK over this period. That again doesn't feed directly into our bank ratings, so that also gives us some more leeway here. And our view today is pretty much the same. I mean, the ins and outs of this saga are hard to fathom for anybody. And what we're focusing on is the fundamental, how does it affect the fundamental strength of these banks? I mean, the one issue that is coming up here is clearly if this, what's called at the moment the no deal or whatever Australian scenario, triggers negative rates on the side of the Bank of England, because that would be maybe not a sort of game changer, because a lot of the short end rates are already negative in the UK, but clearly that would send a sort of pretty bearish signal for banks going forward, as we've seen with the ECB. Once you're negative rates, very hard to manage, clearly not helpful for the banking system, and also it's then not clear how you're going to get out of this again in this environment. So that's the one thing I would say that has changed over the last couple of months, essentially, this sort of tilt towards potentially negative policy rates in the UK.
Okay, very good. Thanks. So just going back to our kind of the narrative that we were going through, Dirk, I want to stay with you because you co-wrote a paper which got published last week on digitization and central bank digital currencies. So I wanted to pose a question to you about digitization. We've all heard a lot about how the process has accelerated as people during COVID have started to basically use online banking and digital banking products, where before they may have gone to branches or whatever, or used a telephone. But taking perhaps a more medium-term view, look, is digitization going to change the competitive landscape in Europe? And over what time frame do you think that'll happen? I mean, is this a real game changer?
Well, it has already been at work for some time, and it clearly benefits the larger banks over the smaller banks. I mean, that's very clear. What we haven't seen yet is shifts in market share. So for this to actually affect credit profiles and I guess sort of the cash flow generating ability of banks, that would have to happen at some stage to really differentiate players here, because otherwise you're just looking at one bank outspending another bank, but without sort of visible benefits here. So we're waiting for that, and we have been waiting for that already pre-crisis. I would think that this year has accelerated that process, also because it's starving some of the potential loan losses are starving one of the sort of smaller players on this sort of investment. So that again strengthens the more powerful players in European banking. And I think the one takeaway, and that's why we did particular focus on retail payments recently, is the whole question of digital platforms emerging as very, very powerful. Clearly seen that in the retail trade. All the shops are closed, but it's also emerged, and we actually mentioned that in our last outlook last year, in particular in China, with the payment platforms that have displaced a lot of the banking-led transactions and payments for some years now already. And we can see that happening in Europe as well. So that again poses, there's two aspects here. One is clearly more money needs to be spent on this by banks if they want to compete in this. I mean, they clearly have the option also to cooperate. So I think that's a question a lot of banks will face. And then the second thing is, it is quite an important, payment fees are quite an important source of revenue, actually, in a low rate environment where you don't make money on intermediation. A lot of banks, particularly if they're relying on the sort of traditional commercial banking model, they will find that payment revenues are an important part of their revenue base. A, they need to protect, and B, they hopefully also want to grow. So that's why we think particularly the area of retail payments and corporate payments potentially as well. But it's really the retail payments which will quite a key battleground here going forward. Again, it does push towards more consolidation here in the sector, with the risk being that some of this moves completely out of the banking sector and moves to other platforms that banks and central banks, for that matter, have no direct access to.
Yeah. Okay. Excellent. There's a question that has come in that I guess we could ask now, which is as follows, gentlemen, which is, can we expect to see a network of European bad banks set up in 2021? And the question that goes on to say, it's a dream of Enria, SSM, but more recently the Financial Services Commissioner, Marie McGuinness, who's announced a plan on this precise subject, will be released shortly. Any thoughts on a network of European bad banks? That's a question to either of you.
Yeah, maybe I take that, because we have commented in the past that we're not so keen on certainly the mega European bad bank. And generally, if now it's said, yeah, there may be national level bad banks, that is possible. I think, Greece is an example here. Portugal, sort of countries that are still suffering from sort of the last wave of P&Ls. I'm not sure the governments are so keen, given all the financial obligations they already have taken on, to take on those assets as well. I mean, they will only do this, in my view, if they absolutely have to. So I can understand that there's certain parts of the regulatory community who are pushing quite hard here at this stage, but I would expect there to be quite a bit of pushback. The issue of bad banks is actually a much changed discussion, or will be a much changed discussion next year, because effectively governments have already set up their own bad banks by providing a lot of government guaranteed funding through banks' balance sheets, but on their own risk. And this is, I think, actually for governments, maybe the more important question next year and the year after. What is going to happen with all these funds that were advanced at this stage? So they're considered to be credit, they're considered to be liquidity. Quite clear, I think, for a lot of observers, a lot of that money, particularly if it went to small SMEs and so forth, not very realistic that this can be paid back, or it can be paid back, but only over very long time horizons, and that may actually may then depress economic activity. So I think from that angle, the bad bank, or the general discussion, how do you recapitalize the economy here next year and the year after, that will be very, very important, actually. But if I had to design the policies here, I would probably not spend too much time on sort of the traditional bad bank model here and think more about, okay, how can I grow, how can I recapitalize the sort of the real economy, ripping assets out of the banks, putting them into some big government organization, in my view, doesn't really speed this up. We also have seen, and this has continued this year, that NPL sales are actually a viable alternative. So they have helped a lot in Italy, they've also helped in Greece and other places. I mean, clearly there the numbers are still very large, but so the private sector also has alternatives here on offer. So that's why personally I'm not a big fan of large-scale bad bank interventions.
Okay, Marco, do you want to add anything to that?
Maybe just the consideration that, and actually, me being Italian and Dirk German, this can be, very relevant. There isn't a lot of appetite for risk sharing in Europe. We've seen it over and over with the European deposit guarantee schemes. The political appetite for risk sharing just isn't there. So you can see, even if you see the national bad bank happening in some countries at national levels, I'm kind of skeptical of how much risk sharing there can be on an asset which is so problematic as NPLs. So I pretty much sideline there with Dirk.
All right. Very good. There was another question that I'll come back to you. I got a question for you, Dirk. I wanted to ask about credit differentiation between banks. But before that, there's a question which I hope you can answer, which is how do you see deposit balances behaving next year? We've seen a recent Bank of England survey highlighting surprising stickiness in deposits there, especially the question that says by the majority who are lucky enough to not face financial distress. So I guess a question of deposit balances. Any thoughts from either of you?
Well, I mean, it's quite clear as central banks keep on expanding their balance sheets, deposits will go up in the banking system. So I think that is inevitable, and I think also, I guess, desired here. In fact, probably central banks would probably want to see more money creation actually within, through lending in the private sector, and then deposits again would increase. So I would expect that to continue next year. It's not very profitable for banks, sadly. So in that sense, it's not necessarily a positive. Now, the other question is if the right deposit balance is going up. That's, I think, leading back to my previous comment that there is indeed a need to decide next year, how do you, or decide now essentially, how you get particular, and as the question alluded, the household sector, but then also the corporate sector up and running again. Because behind every deposit, there is a debt somewhere else in the system. In the lucky case, it's against the central bank, but if it's out in the private sector, we are still dealing with this essentially leverage overhang from this year, and how that's going to be resolved. In my view, an open question.
Yeah, indeed. Okay, I wanted to come back to my question, which I've been wanted to ask Dirk. Perhaps you can kick off with a reaction to this. I think that one of the subsidiary impacts of massive liquidity injections into the capital markets is that credit investors kind of ride the wave, and after that pretty deep volatility early in the at the end of March, you saw this fairly substantial credit rally, and it was pretty undifferentiating in as far as credit investors were funding not just national champions but second-tier banks, infrequent issuers, and all sorts of banks at pretty decent levels. And we've now got to the point where credit spreads are kind of where they were before the pandemic hit. Now, a lot of things we talked about, depending on the outcomes of macroeconomic performance by country, depending on how we kind of get out of these government support schemes, there's a lot of ifs and buts here. But do you expect at a certain point there to be more credit differentiation expressed by investors in the capital markets between weak and strong banks? Maybe not next year, maybe the year after, just a kind of more of a kind of medium-term question. Any thoughts?
Yeah, sadly, the answer is sadly not. because policies are unfortunately designed, monetary policies in particular, to precisely avoid that type of differentiation for the right or the wrong reasons. So I think that at least our anticipation for next year is that central bank policies will stay more or less, well, I guess, sort of on the current path, and may accelerate a bit or decelerate a bit, but fundamentally accommodative. And that will make it very hard for investors to differentiate bank credit. And I think we've seen this for many, many years now. Bank credit is a sort of risk on, risk off trade with very little differentiation. And that will, I think, continue. That doesn't exclude the possibility that individual banks have run into trouble with their regulator, but that will be, I guess, at least this year, this coming year, be few and far between. So that's not a positive message to send here, but I think it's the design of the policy that more or less predicates this outcome.
Yeah, absolutely. Okay. I wanted to move to, I got a couple of questions I wanted to close out with, but there is a question that came in a little while ago, which I wanted to pose first before we move to our closeout segment. And it's about back to this comments that you were making earlier about the dividend ban. And the question is this: do you mean a dividend ban has led to excess capital, and the banks are trying to use up the capital by consolidation? And then the question that goes on to use the example of Nordic banks with high capital buffers and consolidation in that area. I think that was Marco made the comment about excess capital and consolidation, right?
Yeah, I mean, what I meant there is that the dividend ban has led to accumulation of capital. Whether that's excess capital or not will only be clear after all the losses are taken in 2021 and 2022. So from this perspective, I think you don't want to be too aggressive in calling it excess necessarily. But from some banks' point of view, where bank management think they actually have excess capital because they know their books better than anyone else, hopefully, you might look at it that way. So you have these small war chest of capital. You can use it for acquisitions. You can use it to basically to achieve external growth. So yes, in that sense, it can be a driver. I mean, that is trapped capital. If you believe that your asset quality is going to be resilient and you don't expect a lot of losses in the years to come, you look at that capital and think, okay, I've got 500, 600 basis points of excess capital sitting on the balance sheet doing nothing, with the cost of equity of 9%, 10%, whatever it is, and yielding zero. So you look at what's around and you can decide actually to buy out a competitor. Now, I mean, the second part of the question, about Nordic banks, I think it's very specific to that market, and you there have, I would say, a couple of considerations. The first one is that those markets are already fairly consolidated. I'm thinking of Sweden, for example. You don't have a lot of banks there, so the opportunities for in-market consolidations are more limited, which means you should go out and buy some institution in a different country, but we know that the synergies for in-market deals are a lot higher than synergies for cross-border deals, at least for now in Europe, because you have some overlap of branches, some possibility to cut down on distribution costs, which is something you don't get with a cross-border deal. So that might be one of the reasons why this happens less and less. And by the way, we've seen some deals happening in Norway, among smaller banks, including in our coverage. So I would say this could be the reason why this doesn't really happen in Northern Europe as much as it's happening in Southern Europe.
Okay, very good. Thanks for that. Wanted to move. I've got two questions to close out with, and I'll tell you what they are up front. One is, what are your top three takeaways in 2020? And the final one is the top three things to watch out for in 2021, which you can either answer as opportunities to watch out for or risks to watch out for. I'll let you make the choice. I guess I'm not sure if we do three each. Why don't you kick off with one on Dirk, and then perhaps Marco can do another one, and then we go back. So Dirk, top three. What's your top three takeaway from 2020?
2020, I think it was a real surprise to see how well I think the regulators reacted to the crisis, and that particular around this issue of procyclicality in accounting and regulatory frameworks. So we're very glad that this was taken off the table early on, and this underlines our underlying thesis essentially, and that refers to this crisis as well. That in the end, the banking sector is not as cyclical as it probably was in the last crisis, or as people sort of remember it to be recently. So I think that's quite a positive event. The second factor, the takeaway from 2020 is the issue of increased government involvement across the economy in banks, sort of very intrusive sort of policies that we completely did not anticipate at all. We're quite used to it in the banking sector, but clearly not in the rest of the economy. And people talk a lot about long COVID, sort of on the health side, but I think that is essentially the long COVID that is building up in the economy here, because it's not clear to me. Because I was surprised how far governments were supposed to go in their intervention, and it's not clear to me how this can actually be reversed anytime soon.
Markov, what are your observations looking back?
No, we talk a lot, Dirk and myself, so I'm pretty aligned. I would add, you never know what's coming. I mean, this is really, something that was complete shock in terms of the extent of. I mean, we thought, we had tamed the credit cycle. Every credit cycle tended to be sort of milder, and this was a real surprise. And more specific to the banking sector, I would say, this. It's something that has been on my mind for some years, but this was sort of the confirmation. Banks are indeed utilities. I mentioned before, the two traditional functions of banks: maturity transformation, risk transformation. This year we've really seen that the main and perhaps most important function of banks is being the pipelines for liquidity to the real economy. So I look more and more as central bank as the factory, and the banks as the pipelines. So this idea of utility banking, I think, will take hold, and more and more people will get convinced about this. And as a direct consequence, the returns available to these kind of business models are to be lower. So I think, which is good for credit. I mean, from a credit rating perspective, this is not essentially too bad.
Yeah, indeed. Actually, on that score, let me get back to you on this. I know that I guess you and Marco tend to be pretty aligned because you talk a lot. But do you agree that banks owned by private profit-seeking shareholders should be happy with the notion of banks as government-directed utilities?
Ultimately, yes, they should, because as we've seen in other utility sectors, actually, if they're well regulated, they do actually bring down sort of the volatility and the beta, and then ultimately create a sort of dividend-paying, sort of well-priced asset in the equity market. So I think it's just the implementation of that is still. Left wanting here, particularly if we have relapses like the dividend ban this year. But I think ultimately that is would be a very positive outcome. It's actually up to the banks to convince both regulators and markets here whether their risk management can stand up to this environment or not. I mean, if we get some players in a year from now, already put the next outlook into your agendas here, but if there are some strong survivors here, then or some strong banks coming out of this, I mean, a lot will survive, but some coming generally stronger, I think they would be able to capitalize on that quite well.
Okay, very good. And then thanks for that. So let's move then to the top 3 things to watch out for in 2021. You've kind of made reference to them already, but let's just close out with whether you're an investor or just a bank watcher, what are the things that your top 3, as Mark alluded to the takeaways in 2020, Dirk, why don't you kick off with the watch out for items for 2021?
Yeah, so I think what's the theme of 2021 is it's sort of the K-shape. So I think we've seen a lot of K-shape move in markets here. You can start with whatever, Bitcoin going up and dollar going down and what have you. Also China growing, the rest of the world not growing. And we also have certain sectors of the economy doing extremely well out of this crisis. If you think about tech, and then others doing extremely badly. And I think it is really around what will happen in this K-shaped world. I mean, what will the people that took advantage of the situation or were landed windfall simply by their positioning, what will they do essentially with their relative position of strength? Which just suggests to me it is really in the corporate world a lot will be about M&A next year around stronger players taking advantage of weaker players in their respective sectors. And I think it would be quite sad, actually, if the banking sector, yet again, would miss that opportunity and not sort of consolidate along these lines. So that's what I'm really watching out for, that there is more decisive moves to restructure of the banking sector to restructure itself on the back of this.
Indeed. And Marco, what are you? What are things? Anything that you think might keep you awake at night?
You mean aside from the ambulance noise here in Milan?
Yeah.
Okay, I would say we have a base case. Our base case is for this incomplete recovery in 2021, and under this base case, we think it's manageable for the banks. The amount of provisions that need to be taken are manageable out of ordinary profitability for most banks. So what can happen to the downside? So first of all, if we're if vaccines don't work or we end up having a very long vaccination time and 2021 ends up being a terrible year where there is no actually rebound in the economy, that would be a significant downside factor, because essentially a short and sharp recession means that you can freeze everything. Asset prices, real estate prices, which is the main collateral for bank lending, doesn't really move. But if the recession is more prolonged, then it starts affecting real estate collateral values. And then it's a whole different story for bank credit losses. So this I would say is something that worries me a little bit as a downside scenario. The other one is policy mistakes. I think as long as the accommodative stance from the central banks and also the Keynesian approach from government is in place, we won't have anything unmanageable for the banking system. But we've seen in the past that there can be mistakes at policy level. You remember the infamous Trichet hike coming out of the last crisis. So if for one reason or another, say a political crisis in Italy or whatever, a change of direction in the board of the European Central Bank, you were to see an inversion in policy which is too early compared to what is warranted by the economic conditions, then that could be a significant downside scenario for the banks.
Okay, very good. Thank you. At that point, there doesn't appear to be any more questions, and so I think we should possibly then bring the session to a close. So I wanted to thank Dirk and Marco very much for some as ever, very insightful comments. Thank you to you for dialing in and your patience in listening all the way through. As a general rule, the analysts are extremely happy to take reverse inquiries and questions as we go along. So if you have any questions and you want an insightful response, feel free to reach out to Dirk, Mark, and the rest of the team. So that we will continue doing these sessions. In fact, if I may have just a quick advert, we have another session coming up on Thursday, again at 3 o'clock UK time, 4 o'clock European time, on retail payments and central bank digital currencies that we made reference to today. We have a session specifically on that. So if you want to find out more about what the scope view is on where that narrative's going, then join us at 4 o'clock on Thursday, and we'll make sure that we'll send out the link to access that again. So thanks for listening. Thanks for watching, and we'll be back in touch shortly. So enjoy the rest of your afternoons, and as ever, stay safe. Thank you very much.
Thank you. Good afternoon.